Well, record low rates for 30-year mortgages are causing some homeowners to refinance repeatedly. Diana Olick has a look at serial refinancers. Diana, it sounds like a disease.
No, it's actually great, Melissa. I mean, the question isn't why, but why not? Even if you've done it before, there's a chance you could make even more money doing it again. Take a look at where the 30-year fix has gone down below 4.5%, about a quarter point off the 50-year lows set last summer. It's numbers like these that have pushed Andrew and Peggy Sharon of McLean, Virginia, to refinance their home 4 times in 4 years, cutting their interest rate nearly in half.
We've lived in this house for 16 years. We refinanced here the first time to renovate it, and we have refinanced several times afterwards because the numbers made sense.
Now, since they only pulled out cash once, they still have equity in their home, and after a few rounds, they decided to go with an adjustable rate loan, which put them below 4%. They're using a long-term arm, so they don't have to worry about the rate going up anytime soon. They have also worked with their lender to minimize and, in fact, negate any closing costs.
You can refinance with low or no closing costs by opting for a slightly above market rate. Very easy, and that's a no-brainer. You lower your rate, the costs are zero generally on something like that, and you're saving money right away. So there are options for people who are going to be in their home a long time, and there are options for people who think they're only going to be there a few more years.
Now, the trouble is you can't refinance, or you're going to have a lot of trouble refinancing if you are underwater on your mortgage. That is, if you owe more than your home is currently worth, and close to 11 million people are in that position right now. We've got a new report that has some actually alarming new numbers on negative equity. We're going to tell you all about that coming up on the call, but until then, there is much more on serial refinancing on the blog. Go to it, realtycheck.cnbc.com. Tyler?
All right, Diana, thanks very much, and stick around. We're going to talk more about those adjustable rate mortgages, portrayed as the villain in the housing crisis. Now they're making a bit of a comeback, and some say they're neither evil nor toxic. Let's bring in Keith Dumbinger. He's vice president of HSH.com, which tracks the mortgage market. Keith, I've had them both. I've had adjustables. I've had interest only. I've had fixed. I'm a fixed guy right now. Tell me why, in the current low interest rate marketplace, I would want to consider an adjustable rate loan with the fixed loans as low as they are.
Well, given your opportunities, you might find that you could save $20,000, $30,000, $40,000 over the next 5 or 6 years, Tyler. So there's really a very good opportunity to get out there, refinance with an interest rate down in the 3s. And if you can protect yourself, if you're in a reasonable position and you can support higher interest rates later, you might be able to save yourself a bundle of money.
But that's the big risk, isn't it, Keith? That in this environment, bond rates can move up, and a lot of people think that 5 years from now, interest rates are going to be a lot higher than they are today. And if that happens, you're going to end up paying a lot more and maybe carving away at that $30,000 figure that you described there.
It could very well be. I mean, you really need to plan out your time frames looking forward and decide how long I plan on being in this home. If you can match a time frame, a fixed rate period to that time frame, you can save a bundle of money and then move out of your home, sell it, or possibly refinance again, depending upon what happens to the market.
Diana, the couple you spoke to, the serial refinancers, they have a 10-year arm at this point. Do they intend on moving out within that time frame?
Yeah, I mean, look, they're older Americans. They may be moving out between 5 and 7 years from now, perhaps empty nesters. They actually have another property in California that they have also refinanced. They sat down, they did the numbers, and it just made cost-effective sense for them to do this. They're not worried about the rates going up because they will probably get out of this home before that. And even if they see rates starting to go up, they can always refi again.
Keith, what percentage of today's new mortgages are adjustables as opposed to fixed?
Things have crept up a little bit, but we're still in the high single digits. Probably 7 or 8% of the market right now is in some form of adjustable rate mortgage.
So less than 1 out of 10 people are taking adjustable rate mortgages. Based on your view of them, what do you think that thousands, tens of thousands, hundreds of thousands of borrowers are making a mistake by not taking it, what should that percentage be?
Well, probably at 10%. I mean, most ARMs have always been a niche kind of product, meeting the needs of certain borrowers. A couple of years ago, when that percentage got up to 30 or 40 or 50% of the market that was in ARMs, it was pretty obvious that some of those people were ill-suited for those risks. But 10%, 15% is pretty commonplace, and adjustables have been around in the market for nearly 30 years. So it's not as though they don't have a place. It's just a matter of the proper application of the product.
Diana, do you get the sense from your reporting that the banks are pulling back? They're not as willing to give out ARMs, so even though that percentage, should be higher on a historical basis, there aren't that many available in that the banks are less likely to grant that kind of loan.
No, I don't think it makes a difference between the 30-year fixed and the 5-year or a 7-year ARM. It's all about the correct underwriting. If you qualify for a mortgage with that bank, it's your choice to choose what product you want and whether you're going to pay points down on it or not. The thing is, I think the ARMs have gotten a really bad rap because we saw so many bad products during the housing boom, these 1- and 2-year adjustable LIBOR things that were not the traditional 5- and 7-year ARMs, which are much more of a conservative product. And these are not bad products. They're time-tested, and they did not have a very high delinquency rate before, of course, everything came crashing down. Now, if you think about it, that demand is going to come back and you are going to get home sales going again, 5 to 7 years from now, we could see prices on the upswing and people could be selling their houses again.
Chief, you and I go back a long time. I had one of those original adjustables when interest rates were 12, 13, 14%. But it was, I always thought, fair shot or not, that adjustables were designed to let people who couldn't quite afford to get in buy more a house than they really could afford. Fair shot or not?
Fair enough. These are affordability products in their own way. But in today's tougher underwriting standards, you're going to be pretty well situated to be able to manage those risks no matter what happens.
All right, Keith, thanks very much. Diana, thank you as well.